Brexit failing to break the markets after initially plunging 900 points in 2 days. The Dow coming back strong. Overseas markets, for the most part, stabilizing as well. But what will this week bring? After all, the angst that rocked the markets then still exists right now. Let's ask our market pros, Scott Shellady at the CME, Scott Martin in Chicago, and Jonas Max Ferris is here. Scott Martin, make me feel good about these markets.
Well, this week may be a little bit easier than last week, I guess. Let me put it that way, Dagan. But I'll tell you what's going to happen. The S&P 500 is going to go back to focusing on earnings, which have not been really good in the past few quarters. Now, what's going to be interesting is the comments out of the companies that report, because this gives them a chance to maybe hedge their bets a little bit, talk about the problems in Europe, talk about Brexit, and say, hey, going forward, we don't know exactly what visibility looks like. Market, give us a break, and it just might.
Instead of covering your eyes, maybe we ought to hold our nose if we're talking about the earnings season. Scott Shellady, corporate profits have been down 4 quarters in a row, expected to fall again. And then you have the uncertainty of the election coming up.
Right, and then you throw Brexit in on top of that. I mean, we've got a problem here in the States, and Brexit is only 5% of the problem that we have here in the States. Nobody realized that on the Friday that we woke up and the markets kind of had that massive calamity, we had durable goods and capital goods that fell out of bed. Our numbers are still bad. Brexit is a good thing for Britain. Europe's the one that's got the problem. Again, Britain's numbers are up. We've got Draghi that has to come out every year with a euro crisis, say something and do nothing. It's all about Europe being bad. I'm happy for Britain, but here in the U.S., we have our own problems, and Brexit's only 5% of them.
And Jonas, are all those problems here in the U.S., are they factored in the market at this point?
They're factored into foreigns. I think the UK voted for a recession, which they're going to get any day now. So I don't know how good this is for Europe. I will say the stock markets, I think, are going to do well into a recession. It's going to be the weirdest strong stock market in a recession. It's because this whole thing is only going to send rates lower, ultimately even here, possibly negative on the short end, and definitely down to a 1% yield, which is great if you're leasing, buying a car, refinancing a home, and it will prop up stocks. Although the earnings are going down, the earnings relative to a 0.5% or 1% 10-year Treasury bond, which we could see in this crisis involves, is good. And we're not in a deep recession. We're not going to have that because we didn't do the dumb thing that was just done in Europe.
Right. Well, Scott Martin, is that the case, that stocks are just the least lousy choice? Did I say that right?
Yeah, or maybe U.S. stocks are the strongest guy at the beach, I guess, since we are on 4th of July here. I mean, you know, that's the one thing that's interesting. Jonas is right. As rates go down, it actually, Dagan, I think, puts a floor on the stock market. So while we have volatile times like the Brexit and like we did in January and February of this year, as long as rates are moving down, I think stocks don't go much down further.
It's Scott Shellady, but what do you like here? Because, again, you're concerned about the U.S. economy. What looks attractive? Because, again, you get paid. I mean, at least in this country, at least you get paid something for lending Uncle Sam money, because in other nations, you essentially have to pay the government.
Right. I mean, and let's just make one thing clear. I mean, capitalism has a very hard time surviving in a negative rate environment, and it's like a double negative. You can't fight deflation with a deflationary tool. That's the problem here. So, yeah, you know what? Where do you go? I think that you've seen a lot of money already go to gold, number one. But number two is look at the return you get on your bond portfolio year. I don't really say that you should lend your money to the government for 1.5% for 10 years. That sounds bad. But the appreciation in your bonds year over year sometimes has been outperforming the equity markets. And I think you're right. The equity markets are going to be buoyed just because of the fact there's nowhere else for that money to go. But you might find that 10-year U.S. 10-year makes a move to 1%, and that's a pretty big return in 1 year.
Yeah, it is. Jonas, quick final word.
The low rates are good to a point. If it spreads bad and we get back into the $20 oil range and then you start getting those bankruptcies coming up again, the defaults and higher debt, then all of a sudden it's not going to be good for anybody, even here.
Well, you can't have it both ways, Jonas. Do you like stocks or not?
I was buying Italian stocks this week, so I hope it sticks, and I think it'll keep going as long as it doesn't get much worse.
He likes everything.
I'm in, except for I don't like high-risk debt.
He doesn't like me right now.
Stay away from risky debt, because I think that's where the trouble would be if this gets bad.
That will be the final word. Gentlemen, thank you. Scott, and Jonas, happy 4th. Could Donald